Hello everyone. Today I will be attempting February-March 2022 and walking you through this paper. It is the paper 1 variant 2, which is the MCQ paper. The first question says, a production possibility curve shows the combination of outputs an economy can produce using all available resources. At which point on the diagram are all available resources used? If you recall, the production possibility curve is a curve that shows the maximum production or output of two goods or services if all available resources are used fully and efficiently. I'll walk you through the different points. Point Y here shows a point within the PPC. A point within the PPC indicates that resources have not been fully utilized or that they have not been utilized efficiently. There's still more potential left. Both points W and X are points that lie on the PPC curve. These suggest that all resources have been used fully and efficiently. Please note that you cannot be at both point W and X at the same time. There are different options, but both options show that the economy is using its resources fully and efficiently. Whereas point Z is a point that lies outside the PPC. This indicates scarcity. We do not currently have the resources to produce at point Z. So the answer here is A, W, and X only. These points show that all available resources have been used. The second question says, what is a normative economic action based on? Here, I'll tell you the difference between a normative and a positive statement. A positive statement is a statement or action that can be proven or disproven. It presents some sort of evidence that can be tried and tested and either proven as a fact or fiction. On the other hand, normative statements cannot be proven or disproven because they are statements that are based on value judgments. What that means is there's often an opinion attached to it. So opinions cannot be proven or disproven, which is why the answer here is C. Normative economic actions are based on opinion. Just so you know, A would be the answer for a positive economic action. Question 3, which function of money overcomes the double coincidence of wants problem that exists in a barter economy? Let me describe the double coincidence of wants. In the barter economy, every time an economic transaction took place, one of the biggest issues or hurdles was that if you wanted a good or service, you had to go around and try to find someone who wanted something that you had to offer. So not only did this person have to have something that you wanted, they coincidentally had to want something you had to offer. So this was called the double coincidence of wants. So an exchange would take place if both parties were exchanging a good or service. As you can imagine, this took a lot of time and it wasted a lot of precious resources because of this issue. Now, money has various functions. All of these have been presented in front of us. Money is a medium of exchange. It is a standard of deferred payment. It is also a store of value and a unit of account. However, the one that solves the problem of the double coincidence of wants is option A. The fact that money acts as a medium of exchange means that you no longer have to find someone who has who wants what you have to offer. Instead, you can just pay them cash. So the exchange takes place via money, and no longer do you need two parties to exchange goods and services. This solves the problem of the double coincidence of wants. The production possibility curve shows the abilities of 4 economies to produce wheat and rice. Which PPC has the lowest opportunity cost for producing wheat? So again, Each of these curves represent 4 different countries, and we see in front of us different options of what they can produce if they use all their resources fully and efficiently. For instance, country A has a choice. Either they can produce 1 ton of wheat or they can produce 40 tons of rice. What this means is if they choose to make 1 ton of wheat or produce 1 ton of wheat, what they have to give up is 40 units of rice, which means the opportunity cost of 1 wheat is 40 rice. On the other hand, country B, they can either make 4 tons of wheat or they can produce 40 tons of rice. So here's the opportunity cost. 4 units of wheat is equal to 40 units of rice, which means that 1 unit of wheat is equal to 10 units of rice. Every time they decide to make 1 unit of wheat, the opportunity cost is 10 units of rice. We have presented the per unit opportunity cost for country C and country D as well. Every time country C produces 1 unit of wheat, they give up 13.3 units of rice, whereas country D gives up 20 units of rice. So who has the least or the lowest opportunity cost for producing wheat? The answer is country B. They give up the least amount whenever they decide to produce 1 unit of wheat. The answer is B. Question 5, the diagram shows a supply curve for chicken. This is an upward sloping supply curve. This curve shows a positive relationship between price and quantity. What that means is if the price increases, so will the quantity supplied. They both move in the same direction. Now, why are supply curves upward sloping? What explains the relationship, the positive relationship between price and quantity? Well, first of all, if you produce more quantity, the price will need to increase because as you produce more, the cost of production increases. So in order to cover that extra cost, the price needs to increase. Another way to explain the upward sloping supply curve is that the greater the price, the greater the profitability of the product. And so the suppliers are willing to supply more of that product. So both because of the profit motive and because of the cost associated with more quantity, there's a positive relationship between price and quantity supplied. The only answer that fits this description is D, which is the cost of additional chicken production rises as output increases. This is true. As you produce more output, the cost increases. And so as the cost goes up, so will the price. Question 6, the diagram shows the demand and supply curves for cars in India. The initial equilibrium is at X. What will be the new equilibrium if there is a subsidy given to Indian car manufacturers and there's also an increase in the price of train and bus journeys in India? Whenever you see a question like this with a bunch of supply curves and demand curves, I suggest you place your pen on the first equilibrium point, which here is X. So you place your pen on that point and you take the information one at a time. The first information that has been given is that there has been a subsidy given to car manufacturers. A subsidy is a grant provided by the government. Its aim is to lower the cost of production. And when the cost of production decreases, the supply increases. So from S1, we will now be moving to S3 because now the cost of production has fallen and the supply curve has shifted to the right. So we find ourselves at this point. The next information that has been presented is that there has been an increase in the price of train and bus journeys. What is the relationship between train and bus journeys and cars in India? I consider them to be substitutes. If you have a journey to take, either you will take the bus or the train, or you will travel in your own car. So these two sets of transport can be considered substitutes. So if train and bus journeys are becoming more expensive, people might be more inclined to travel in their own cars instead. Therefore, the demand for cars in India will increase, shifting the demand curve from D1 to D3, which is why we end up at point B, which is our new equilibrium point. Question 7. Demand curves are drawn ceteris paribus. Ceteris paribus means, it's a Latin phrase that means that all other factors have been kept constant. What that means is, aside from the relationship that is being studied and observed, all other factors, other variables that could possibly hinder or affect the result will be kept constant. However, the thing that isn't kept constant, or the variables that have not been considered constant, are the two variables that are being considered in the relationship. So when you draw a demand curve, the relationship that you are observing is a relationship between price and quantity demanded. So we want to observe the effect of price on quantity demanded, and all other factors aside from these two will be kept constant, which is why it says which other things are not required to remain the same when an individual's demand curve for ice cream is constructed. The answer is D, the price of ice cream, because that is the relationship that is being observed. We are observing the amount that quantity demanded will fall when the price of ice cream increases. So the price will not be kept constant. Otherwise, there's no relationship to study. Now, A, B, C are other variables that could impact the relationship, and therefore we consider them constant. For example, the consumer's income, their taste and preferences, the price of fresh fruit, which could be considered a complement. All of these variables, if altered, could change the demand for ice cream, and therefore would change the demand curve being studied. Question 8, what is the measure of cross elasticity demand for good X in terms of good Y? This question is pretty straightforward. It is essentially asking you what the formula for cross elasticity of demand is. If you remember, cross elasticity of demand studies the responsiveness of quantity demanded to the change in price of another. The answer here would be C. XED is equal to the percentage change in demand for X divided by the percentage change in price of Y, and that will give you XED. Question 9. When will the price mechanism be least likely to reallocate resources to meet a change in consumer preferences? Let's analyze what the price mechanism is for a second. We have the demand curve and we have the supply curve. The demand curve represents consumers' preferences for goods and services. They buy goods and services because they want to satisfy a need or a want. That's their motive. And then we talk about the supply curve, which represents the producer's willingness and ability to supply goods and services. Their motive is profit. Keeping in mind the profit motive, producers will allocate resources towards consumer preferences when they believe that those preferences will be profitable. This is not the case with public goods. Public goods, by definition, are goods that are non-rivalrous and non-excludable. Non-rivalrous means that the consumption of a good by one person will leave no less for any other. And they're also non-excludable, which means that even if you do not pay for this good, you can't be excluded from its use. For that reason, public goods are by nature non-profitable. So the price mechanism doesn't really function when it comes to public goods. Public goods suffer from the free rider problem, so they tend not to get produced unless provided by the government using tax revenue. So in this case, the price mechanism will be least likely to function according to consumer preferences when they relate to public goods. That cares about profit will not be concerned when there's a change in preference for public goods because it doesn't provide them the profit that they need. So, this is the one that will get ignored when it comes to the price mechanism. Firm estimates that the price elasticity of supply of its product is 1.5. This indicate? Here is the formula for PES. Percentage change in quantity supplied upon percentage change in price. This formula will always give us a positive value because both are positively related. Every time the price increases, so will the quantity supplied and vice versa. So you will always get a positive value. But here's the range of values. And plus 1.5 lies within this range here. Plus 1.5 indicates that this product has a relatively elastic supply. So what that means is that quantity supplied generally responds quite strongly to a change in price. In other words, the supply has the ability to respond to a change in price. So let's question why supply could be responsive. One reason why supply is responsive is if the company or the producer has stock of this product available. So that means they've already have this product in stock, and if required, they can release the stock, which means that their PES is elastic. They can also, PES can also be elastic, or there could also be elastic supply when there's spare capacity. So that means that the producer has the ability to increase supply because they have resources that have not been fully utilized. So they can increase supply easily, more easily, if there's a change in price. Given this, the answer that is most relevant is A, which is the firm has available stock. This would suggest that PES would be elastic, and that is why that's the answer. Question 11. A rise in the price of a good is accompanied by an increase in the quantity demanded. What could explain this? This is quite unusual. Normally, when the price of a good increases, the quantity demanded falls. There's an inverse relationship between the two. That's why the demand curve is downward sloping. But the fact here that price is increasing and quantity demanded is also increasing suggests that for this good, the demand curve is upward sloping. This is considered an exception to the law of demand. As you can imagine, this is a very unique good. Such goods are called Veblen goods. In this case, the price increasing actually indicates something to the consumer. That's not common. For Veblen goods, the price increase actually convinces the consumer to purchase even more of this good or service. The reason is that they might consider the price to be an indication of the level of quality. Sometimes they even consider the product to be a status symbol. So the fact that the price is increasing is actually, it becomes more attractive to them because that was the whole point. The point is to display something that is expensive as a symbol of opulence or wealth. Right? So you were thinking items such as designer watches or luxury jewelry, things like this. You find that if the price increases, people want to buy more of it. So either the price is linked to quality or more desirability. So the only one that fits this description is option C, where the price of a good is taken to be an indication of the level of quality. And these are called Veblen goods. They're considered an exception to the law of demand. And in this case, as the price increases, quantity demanded also increases. So it's an unusual case. Question 12. What causes the demand curve for an inferior good to shift to the right? In other words, what would cause the demand for an inferior good to increase? If you recall, an inferior good is a good whose demand increases when there's a fall in consumer income, which is why the answer is A, first of all. This is the opposite relationship of normal goods and income, because for a normal good, when income rises, there's going to be an increase in demand. But an inferior good has an inverse relationship with income. The diagram shows the effect of a change in the market for good X on the market for good Y. What is the most likely relationship between the two goods? So let's analyze what's happening here. Something's changed in good X, and that change is having an impact on good Y. So what is happening to good X? So initial equilibrium was S1 and D1. However, there's been an increase in supply to S2. And this new equilibrium is a greater quantity and a lesser price. So the price of this good has fallen. An increase in supply has caused the price of this good to fall. So this fall in price has somehow had an impact on good Y. In fact, the demand for good Y has increased from D1 to D2. So a fall in price of good X has led to an increase in demand for good Y. This would suggest that good X and Y are complements. When there's a fall in the price of one good, and this leads to the increase in demand of the other, it suggests that the two goods are complements. For example, if the price of PS5 games fell, then this would lead to an increase in demand for the PS5 console. Question 14. To improve its financial position, a government decided to reduce expenditure on investment in the public sector. There was not a fall in economic growth. What was the most likely effect of the government's action? Let's discuss government spending. So let's analyze the government budget. The government budget consists of government revenue and minusing the amount of spending that they do on the economy. If this results in a positive value, that means that they still have revenue left and that their budget is in a surplus. However, if they end up spending more than the revenue that they have, their budget will be in a deficit. So in this question, the government spending has decreased. Either this means that the budget surplus will increase, because let's just say they were already in a surplus and now they're spending even less, that budget surplus will increase. Or the other option is their budget deficit will decrease. That means that they were in a negative, they were spending too much money, and now that they're spending less, that deficit will fall. So it's not like they've recovered completely, but the size of the deficit will fall. And so the answer in this case that most resembles this discussion is A. Let's look at the other options. A budget surplus was reduced. That's not going to happen. You're spending less money, so the surplus would actually increase. Consumer spending, it's got nothing to do with the government's budget deficit. Option D, public sector productivity decreased. If there was a decrease in public sector productivity, there'd be a reduction in output and a fall in economic growth. And clearly the question has said that there will not be a fall in economic growth. So B, C, and D are out. Question 15. What are the effects of a government imposing maximum price below the equilibrium price? An effective maximum price is a price that is set below equilibrium. So essentially the price is now reduced. At the old equilibrium, Q1, quantity supplied was equal to quantity demanded, which is why it's called the equilibrium situation. P max, however, can be described as a disequilibrium situation. At this point, quantity supplied and quantity demanded will not be equal. In fact, because the price has been reduced, it hits the supply curve at this point and quantity supplied will fall to QS. And at P max, which is a lower price than equilibrium, the quantity demanded will increase all the way to the point it hits the demand curve. And so quantity demanded will be, at this point, higher than the original equilibrium. You can see the quantity demanded has increased from the original amount and the quantity supplied has actually fallen, which is why the answer is C. For your information, this is called a shortage situation. There's actually greater quantity demanded than there is supply available. So there's going to be a shortage in the market from the P max, which is actually one of the drawbacks of this situation. Question 16. The National Library Board of Singapore is a public sector organization that finances and manages the state libraries. What is the most likely reason for this? For this one, I suggest going through the options and thinking about if they're relevant or not. Let's look at option A. Are libraries truly public goods? They are not. They are not non-rivalrous, nor are they non-excludable necessarily. People can be excluded from this library, and it possibly also has a full capacity amount, after which people might be turned away. So it's not a public good. Are libraries a merit good? Keeping in mind that a merit good is a good or service that generates positive externalities. Could books or a library generate positive externalities? I think that's true. The more books you read, possibly the more educated you are, the more well-informed you are, more informed, and so on. So I believe that libraries are a merit good. This is the answer for me. But looking at options C and D, the cost of providing library services would be greater in the private sector. That's not necessarily true. The private sector is often considered quite efficient, especially because they have the profit motive. So this may or may not be true. The private sector could very well be very cost efficient. Lastly, the opportunity cost to the public sector providing library services is zero. Very unlikely that the opportunity cost is ever going to be zero when you're providing a good or service. The government is spending money on this service, and the money could have been spent elsewhere. It could have been spent on education, on healthcare, on infrastructure, and so on. So D is also out. Question 17. 3 types of taxes are listed. The first one is a sales tax on fuel. The second is a specific tax on cigarettes. And the third one is an income tax, where the percentage of tax increases as the income increases. We have a few options here describing the tax as either being progressive or regressive. Progressive tax is one where the average tax burden increases as income increases. A regressive tax, on the other hand, is where the average tax burden actually decreases as income increases. In other words, the lower income earners end up paying a higher burden of tax. In other words, low income earners end up paying a greater proportion of their income in taxes than high income earners. A sales tax allows governments to collect tax from the consumer at the point of purchase. In Pakistan, for example, the sales tax is around 17%. So it means every time you make a purchase, at the till, you're charged an additional 17%. This tax can be considered regressive. The reason is it does not take into account the person's income. Regardless of your income, low income earner or high income earner, you're going to end up paying 17% of the final price. So what that means is it takes up a greater proportion of low income earners' money than it does a high income earner. In that sense, it is a regressive tax. Next, there's a tax on cigarettes. This can also be described as a sin tax, by the way. A sin tax is imposed on goods and services which are perceived as harmful to society. A sin tax is notoriously considered a regressive tax. That means this tax places more of a burden on the poorer parts of the population and less of a burden on the wealthier population. And interestingly enough, it is also found that low-income earners tend to spend more on these goods anyway. So not only are they buying more of these products and services in general, they're also paying a greater proportion of their income in taxes on these goods and services. So it's regressive. It should be clear that the income tax is progressive because as your income increases, the percentage you are taxed also increases, which means that the amount of tax you pay progressively increases as your income goes up. So the answer is D, regressive, regressive, and progressive. Question 18. The bus fare in a rural area is $5 per journey. The government decides to improve local transport by giving bus firms a subsidy of $2 per journey. The diagram shows the possible changes in demand and supply. What is the new quantity of journeys and the bus fare for a journey? The subsidy will reduce the cost of production for the producer, shifting the supply curve to the right. So from S, let's call this S1, the supply curve has shifted to S2. So the new equilibrium point is, it used to be at $5 and now it's at $4. Note that you can find the amount of subsidy per unit by looking at the vertical distance between the two supply curves. So the vertical distance between S1 and S2. If you can see, the vertical distance is $2, which is exactly what we are looking for, $2 per journey. So we know that this is correct. So the equilibrium price used to be 5 and now it's 4. So which leaves us only with option C. And we can see that at $4, the quantity that will be sold of bus journeys is 1,050. Question 19. The diagram shows the annual consumer price index for Japan over the years 1990 to 2010 inclusive. In which period did Japan experience both inflation at a rate of approximately 2% and deflation at a rate of approximately 2.5%? Just a reminder, inflation is a general and sustained rise in prices, whereas a deflation is a fall in prices. If the percentage change is a positive one, if the CPI has a positive change, that means that the country has experienced inflation. However, if there's a negative percentage change, that means prices have fallen and deflation has occurred. So we're looking for an inflation rate of around 2% and a deflation rate of around 2.5. So a positive value around 2 and a negative value around 2.5. What I've done is I've drawn a straight line from the 2% mark showing inflation and a straight line from the negative 2.5 line showing deflation. So we can see that an inflation rate around 2.5% occurs in this year, around 2009, I'd say. And then the country experiences deflation in around of about 2.5 in 2010, which is why the answer is D. Question 20. A government removes its quota on imported laptops. Assuming a normal demand curve and an upward sloping supply curve for laptops, what are the likely effects on domestic laptop manufacturers? The following diagram shows you what takes place when there's international trade. This is the supply of laptops in the local market. This is the demand for laptops in the local market. And now they're engaging in trade, which brings down the price to P. And at this lower price than what is offered in the economy locally, consumers want at least QD laptops because the price has fallen. But at this lower price, the domestic producers can only accommodate QS supply. That's all that they're willing and able to offer at this lower price. So the difference between QD and QS is then imported. In order to lower the amount of imported goods in the country, the government might impose a quota. So now this pink line is no longer the supply that's available. The supply that's going to be available in the domestic economy is what was produced locally, which is the blue line, plus a little extra that has been allowed per the quota to be imported. So this is going to be the new total supply, which is the domestic production, plus the amount that has been imported as per the quota. As you can see, with this quota, the price has been pushed up to P3 because the supply has now become more limited. At this higher price, the local producers are now willing to supply slightly more product. So instead of QS, they're now willing to supply Q4. And sadly, because the price has increased, the consumers will only want Q3 products. So the amount of imports has decreased. The revenue received by local producers has increased because of this higher price. And so will their income, right? If this quota is removed, what that means is that the domestic economy will go back to importing according to the free trade line, which is the pink line. They no longer have a limit on how much laptops they can import. They can import according to the free trade line. So price is going to fall all the way back to P now, which means that the domestic manufacturers will receive less, the price will decrease, and that the domestic manufacturers will receive less income because the price has now gone down and they can't supply as much at this lower price. So their income will also decrease, which is why the answer is A. Question 21. The terms of trade index for Mauritius fell from 111.2 in the first quarter of 2018 to 106.1 in the second quarter. Which combination could have produced this outcome? Let's remind ourselves of the terms of trade formula, which is index price of exports upon index price of imports times 100. If the TOT is fallen from 111 to 106, let's analyze why this might be according to this formula. There are a few reasons why the TOT value may fall. Firstly, the numerator may have decreased, which means the value on top may have fallen. Exports may have become cheaper, which would cause the TOT value to fall. The second reason is the denominator may have increased, again resulting in a smaller TOT value. The numerator and denominator both may have decreased, but the numerator may have decreased even more than the denominator. Lastly, the numerator and denominator both might have increased, but the denominator may have increased by more. And that is actually the option we're looking for, which is option B. The price of exports may have increased, but the price of imports may have increased by even more than that, causing the overall TOT value to fall. If you look at the other options, they would all result in a higher TOT value. If the export prices rose and the import prices fell, the TOT value would increase. If the export prices rose, nothing happened to import prices, the value would still go up. And lastly, if nothing happened to export prices and import prices fell, the TOT value would increase. So the only answer that is relevant is option B. Question 22. From the initial position of equilibrium shown, there's an increase in government expenditure on goods and services, and simultaneously an increase in the cost of production of goods and services. What best describes the likely impact on the economy? First of all, there was an increase in government expenditure. If you recall, the AD is made up of components C, I, G, and X minus M. When there's an increase in the component government spending, it will shift the AD curve to the right. There has been an increase in the cost of production. This will decrease the aggregate supply and shift the curve to the left. Look at the new demand curve and the new AS curve, and the equilibrium at which they both meet. The price is definitely higher, so the price level has gone up. There's no debate about that. But when you notice the real output, it seems not to have changed. However, let's just say the AS curve had shifted even more to the left, or the AD curve had shifted even more to the right, then the quantity would have changed. The price level will increase regardless. What is uncertain what would happen to the real output, because that depends on the magnitude of shift of the AS curve and the AD curve. So the answer is E, because it is for sure that the price level will increase. However, it is uncertain whether the equilibrium national income will increase or if it will stay the same. The diagram shows a shift in an economy's aggregate demand curve from AD1 to AD2. What could not be a cause of the shift? So again, here's the formula for aggregate demand. The components are consumption, investment, government expenditure, and net exports. Any factor that will alter any of the components of AD will cause a shift of the curve. So we're looking for one that would not cause any of the components to change. Let's look at option A, a decrease in income tax. A decrease in income tax will allow for more disposable income. It will definitely lead to a rise in consumption and would shift AD to the right. A is out. C, an increase in money wage rates. If people receive a higher wage rate, again, this would lead, at least momentarily, to a rise in consumption. C is out. An increase in money supply, this would lead to, again, more consumption, possibly more investment too, and would lead to the AD curve to shift. Now, if you look at B, a decrease in the price of goods, this will lead to a movement along the AD curve, not a shift of the curve. So B is the answer. Which item is not included in the current account on the balance of payment statement? Here are the four subsections of the current account. The balance of trade of goods, which includes both the exports minus the imports of goods, the balance of trade of services. These two sections of the current account are sometimes clubbed together and called the balance of trade. Then we have the primary income balance and the secondary income balance. Answer to this question is A, and let me explain why. All other options are included in the current account. The export of services will be included in the balance of trade of services. The import of goods will be included in section 1, the balance of trade of goods. The interest received from investment overseas will be included in the primary income balance. The balancing item is not included in the current account. The prices of a country's exports rise by 5%, while the prices of its imports fall by 5%. What will definitely improve in the country as a result of these changes? We're looking for an improvement in one of these concepts. First, we have the balance of trade. The balance of trade is a section included in the current account. As we've seen, it includes the balance of goods, the balance of services. So if exports are becoming more expensive and imports are becoming cheaper, it is possible that the balance of trade will not improve, it could deteriorate, especially if the Marshall-Lerner condition is met and the PED of exports and imports is actually elastic. When it comes to the current account balance, this includes the balance of trade. So for those same reasons, it is uncertain what would happen to the balance of trade or the current account if the exports become more expensive and if the imports become cheaper. It depends on the elasticity. Similarly, with the exchange rate, there are a lot of factors that can alter or affect the exchange rate, including demand for exports, including the amount of protectionism, and so on. So just because prices are changing for exports and imports, we can't for certain say that the exchange rate will improve because of these things. However, when it comes to the terms of trade, we can say for certain that this will improve because the numerator is increasing, which is the index price of exports, and the denominator is decreasing, which is the index price of imports. So it is for certain that the TOT, or the terms of trade, will improve. Therefore, the answer is D. What is not a form of protectionism? Well, I'll jump straight to the point. The answer is B, and I'll explain why. A is embargoes. Embargoes are when one country bans trade from another country. It might be for political reasons. It might be purely because they just want to protect the country against imports, and this would help the balance of trade in the current account. It could be because of war. So this is a complete ban on, imports from one country to another. The next C, subsidies on goods for export. This is when the local government provides subsidies to domestic producers in order to lower their cost of production, lower the final price of the product or service, and therefore make the product more desirable in the export market. It's a form of protectionism. It protects the domestic industries against foreign competition. D, voluntary export restraints. This refers to when an exporting country limits the amount that they export to another country. Again, it's a form of protection against free trade. An increase in sales tax, this is a domestic action. This is when a tax is added at the point of sale and on domestic products that are sold locally. It has nothing to do with protectionism. Two countries X and Y produce food and drink. The table shows how many hours it takes them to produce 1 unit of each good. What will be the result if country Y doubles its productivity in the output of drink and both countries produce only 1 good according to comparative advantage? First step is to make sense of what the question is informing you of. It tells you how many hours it takes to produce 1 unit of each good, hours. So it takes 10 hours to produce 1 unit of food, 2 hours to produce 1 unit of drink for country X, and so on. I've listed here how many units would be produced in 1 hour for each country. For example, for country X, in 1 hour, they would be able to produce 0.1 units of food or 0.5 units of drink. So I'm comparing how many units they'd be able to produce in 1 hour for both these goods. For country Y, 1 hour would result in 0.2 units of food and 0.08 units of drink. So clearly, according to comparative advantage, X seems to have the comparative advantage in producing drinks. In 1 hour, they're able to produce more drinks than country Y. So that's what they should do. This is before any change in productivity. However, now there's been a change in productivity. Y has doubled its output in 1 hour of producing drinks. Maybe they've got some sort of machinery or they've invested in capital goods. So in 1 hour, instead of being able to produce 0.08 units of drink, they're now able to produce 0.16. So they've doubled their productivity only in the production of 1 good. But they are still producing less drinks in an hour than country X, which is why the answer is A, that country X should continue to produce drinks because that is the one that they have the comparative advantage in, which means that they have less of an opportunity cost compared to country Y in the production of drinks. Reducing the exchange rate helps to decrease a country's balance of payments deficit because it makes imports more expensive and exports cheaper. What does this statement describe? Let me just explain what's happening here. The exchange rate is being devalued or it's falling in value, and therefore exports will become relatively cheaper, whereas imports will become relatively more expensive. If the PED of exports and imports is greater than 1, which means that they are elastic, they will respond to this change in prices. Because of that, the value of exports would rise, whereas the value of imports would fall. This would lead to a fall in the balance of payments deficit because the balance of trade within the current account will rise. This will lead to a decrease in the balance of payments deficit because within the current account, we have the balance of trade, and the balance of trade will rise because of this. So the deficit of the BOP should fall. Now, let's see what describes this scenario. A deflationary policy, is this reducing prices in the economy? Not necessarily. In fact, if the BOT rises, AD is made up of C, I, G, and X minus M. This could lead to a rise in the net exports, and it actually could end up causing inflation. So A is out. A policy of direct controls. Direct controls are imposed by governments which expressly forbid or restrict certain kinds of investment or economic activity. So it could be their way of controlling prices or wages in order to have some sort of effect on inflation. But this is not what's described here. An expenditure reducing policy, this refers to a fall in aggregate demand. A fall in aggregate demand can be achieved through either a contractionary fiscal policy or a contractionary monetary policy. Well, the answer is going to be option D. This is when the government tries to encourage local consumers to switch to local products instead of buying foreign products. If they decrease the exchange rate, this is what they are trying to do. They're trying to get people to switch their spending away from imports towards local products. So this is an expenditure switching policy. An increase in which variable is a contractionary monetary policy? This one is relatively simple. A contractionary monetary policy involves two actions by the government. Either they will increase the interest rates. This will increase the cost of borrowing, and it also increases the rate of return for interest. So what that will do is it will reduce consumption and reduce investment, which are both components of AD, and will cause AD to shift to the left, which is a contractionary monetary policy. Similarly, if money supply is reduced, there'll be less consumption in the economy, and this is also considered contractionary monetary policy. So we have our answer right there. The interest rate will be increased, and that can be regarded as a contractionary monetary policy. Last but not least, question 30. What are government monetary policies that would be most effective in a global recession? A recession is when there's a downturn trend in the business cycle, and it's characterized by a decline in production and employment, which in turn causes the income and spending of households to decline. So the economy is actually going into a decline, and we want to reverse the situation. In some ways, this is the opposite to the previous question. We're looking actually for an expansionary monetary policy. We're looking essentially for a rise in money supply and a reduction in interest rates. These two actions will encourage more consumption, more investment, less savings, and will actually kickstart the economy, encourage the aggregate demand to shift to the right and economic growth, which should hopefully reverse the effects of the recession. So we're looking for these actions, which is why the answer is C, keeping the rate of interest low and increasing the money supply. So that concludes our discussion on this paper. I hope it helped you, and good luck for your exams.